market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. The US Treasury Secretary Scott Bessent has threatened economic punishment against any country doing business with Iran. It comes as part of what he calls an economic D-Day campaign to end nearly 6 months of war.
Today we are launching Operation Economic Outcast to foreclose every other option available to the Iranian regime. Treasury has mapped every node, every facilitator, and every network that Iran has used to smuggle oil and evade sanctions. Beginning today, the actions of Treasury and other agencies will tighten the noose and block every potential source of revenue that funds the IRGC and the evil Iranian regime.
The move risks setting the US on a collision course with China, Iran's main trading partner, of course. So let's bring in for analysis Jill Desis, our managing editor in Hong Kong, and Brendan Murray, our global trade czar here in London. Welcome to both of you. Jill, I want to start with you because this felt more like a warning shot from Bessent. There was no timeline, no specific punishments set out. Is there a sense that Iran's more likely to retaliate militarily, perhaps, than to capitulate?
Yeah, I think at this point, Lizzie, you've heard some very, very strong language out of the United States. Economic onslaught, I believe, was also, part of that language there. At this point, we did hear a bit from Iran just before Bessent spoke. I'll read you the quote from their lead negotiator with the U.S. saying, Americans know that no one buys their bombast. The United States is not in an economic position to further restrict its relations with other countries. And so I think that does tell you a little bit about, how Iran is thinking about some of this language here. The other thing that I'll note with all of this, Lizzie, is that, at this point, again, a lot of this is very vague. As you mentioned, there's not a whole lot of timelines here. There are some entities in China and Hong Kong that the U.S. government did target. A lot of that's sort of smaller companies involved with tech procurement, that kind of thing. So despite, some of this, you're not seeing yet, specific targets on, say, major Chinese banks or major, secondary sanctions that could conceivably impact, China's trade with Iran when it comes to oil, for example. So I think that that's really where, more of that economic pain would really come into the equation. And at this point, it still does feel, as you mentioned, that idea of that warning shot rather than something that really, may, be that sort of next level of aggression.
Well, yeah, because Bessent didn't mention Beijing by name, but he did say that nobody is above the reach of US sanctions. How much does it just crank up the tensions ahead of the Trump-Xi summit?
Yeah, I think that's a good point, is that we have this summit between, Donald Trump and Xi Jinping expected next month in Washington, D.C. I'm not sure that Washington necessarily wants to upset the prospect of that meeting upcoming. We did actually hear from China's Ministry of Foreign Affairs just about an hour ago, some boilerplate language from there about, opposing sanctions and that kind of thing. So nothing too surprising out of China, at least at this point. I will also say, Lizzie, that one other consideration that may be entering the U.S. equation right now is they've got this trade truce, for the better part of a year so far with China. Some questions about whether or not they're sort of looking to alter the trade relationship. But I do think that's another thing, that if you're trying to make this meeting between Donald Trump and Xi Jinping happen in just about a month's time, risking upsetting that relationship is something that, potentially they're very sort of cautious to. So we'll have to see whether or not, the U.S. does come out with something that feels a bit more aggressive. If they do something like, again, target a major Chinese bank as a result of these types of sanctions, upping this economic pressure on Iran. But at this point, we're still kind of waiting to see whether or not that actually bears out.
All right, Jill, thank you very much. That's Bloomberg's Jill Desis. And Brendan, I want to bring you in here because talking of China, we also understand that the US is set to impose a 7.5% tariff on Chinese goods. This is over allegations of excess manufacturing capacity. Do you think it's likely to actually come into effect, or is this the sort of negotiating ploy that we've seen from Trump before?
So this is part of a negotiation that the U.S. trade, an investigation that the U.S. Trade Representative's office is doing in parallel with one that they already did regarding forced labor. So they put 12.5% tariffs on China and some other countries, and if you add the 7.5% for the excess capacity, then you get to the 20% that the second-term Trump administration has put on China. So this was a level that China has accepted, more or less, from the ceasefire dating back to November of last year. And so the calculus from the Trump administration's perspective is that this will maintain a bit of stability. No country wants extra tariffs, but China has accepted the 20%. And so we don't have the investigation released from the USTR yet, but this is what our sources in Washington are telling us. And here we are, less than a month now from the Xi-Trump summit, and there'll be a lot of jockeying, a lot of negotiations behind the scenes to figure out what the deliverables will be for that summit. But this is one that the U.S. administration thinks that China will accept and will sort of keep the pressure on the U.S.'s trading partners to do the kind of reshoring that the Trump administration is trying to accomplish.
So just kind of rebuilding the tariff wall rather than adding to it. We also had Trump vowing to double tariffs on Canadian autos to 50%, and this is from January the 1st. Obviously, that could significantly disrupt the supply chain. Let's just take a listen to what Mark Carney, Canadian Prime Minister, of course, had to say.
The goal of our trade negotiations with the United States has always been to get the best deal for Canadians, never a deal at any price or on any time frame. Well, we made progress, and we did make some progress in recent weeks. In the end, that momentum reversed, and we could not accept what the U.S. had offered, nor could we give what they asked.
Is there hope, though, that there could be negotiations if the deadline's January 1st, if they put it off to all that way away, and they said they might not do any talks until after the midterm? Surely there's a window of hope there.
Yeah, absolutely. Look, things are pretty ugly now between the two economies. The politicians are calling each other names, but ultimately the U.S.-Canada trade relationship has to work for both countries. It will be detrimental to both economies if things fall apart and tariffs start escalating. And so what we're seeing the point at which the two sides are kind of yelling at each other, but ultimately the lawyers on both sides are going to sit down and hammer things out, close these differences, and figure out how to make sure that they don't disrupt either economy. The thing that Canada has going in its favor are the political costs that this could come to bear on the Trump administration in the midterm elections. There are a lot of border states with close Senate races that Republicans don't want to lose, and so we'll have to see how the political pressure makes its way to the White House. But we're already hearing from some folks in Michigan and Wisconsin and other areas that are going to be affected by this, that the U.S. doesn't want to get into a full-blown trade war and punish Canada in the way that the threats are flying around right now would suggest.
Yeah, you talk about that ugly language. Clearly, the auto tariffs targeted at Ontario, and we know that President Trump hasn't taken very kindly to Doug Ford in that area. Brendan, thank you so much. That's Bloomberg's Brendan Murray. Well, Treasury Secretary Scott Bessent, in those Iran comments, refrained from giving any further signals on how he's going to revamp US debt management. It follows a report that his department could draw down some of its cash pile to fund buybacks of longer-dated bonds. I'm joined now by Karen Ward, EMEA Chief Market Strategist at JPMorgan Asset Management, for more on this and everything else that's been going on in the market. Karen, are you worried, let's start here, about the risk that this Treasury intervention is going to weaken the dollar, cheapen exports, and then fuel inflation?
I certainly think the currency will be the valve. I mean, we've seen this play out very clearly in Japan. When the market is uncomfortable about what's going on in the policy space, and usually that's a judgment on the combination of fiscal and monetary policy, but there's quite a determination from the central bank to try and keep the bond market under control. That distaste from the market comes through in the currency, and that is what we've seen over this last week with the US intervention. The market is watching. Again, it's the combination of fiscal and monetary policy and how they may interact, and the valve is the currency. So I think keeping an eye on where the dollar's going, your exposure to the dollar, because we know most people are overweight the US in general. When you add in currency exposures, it's pretty significantly overweight. It's something to be aware of, for sure.
Well, because of this, some people are talking about the debasement trade having to come back. You've seen Bitcoin, it has been over 80k this morning. I'm not sure it is just, you might be just shy of that right now, but isn't it a sign that the debasement trade's coming back, partly because of what Bessent's doing?
I mean, I think it is, yes, is the answer. But I think it's not just about the US. I think the markets are judging that this is structurally where we are. I mean, for everything you've been already talking about this morning, we are just in a world where governments are under tremendous pressure to spend a lot more. They're onshoring, again, all their activities, whether it's defense or energy infrastructure or technology and manufacturing. So if governments are going to be spending more, they're going to really would like their central banks to, in whatever way, help them out. And I think the pressure on Japan, the pressure on the US, the pressure on governments in Europe, it's a general perception by the market that I just need to insure myself against this going too far. You know, I would say that generally for risk assets, this is great. This is everybody spending money trying to get growth going. The risks, history tells us you can push that too far, but you need to be a little careful, because when it goes wrong, it ends up in either in inflation or it ends up in a misallocation of capital. So that's my key advice to people at the moment. Enjoy it. Forget all of this daytime, you know, what's been said, who's tweeted what today. This is going to be very positive for risk assets, but have your insurance in place, being mindful of those risks.
But can we forget about it? It's been an absolute pile-on of criticism for the Treasury Secretary. Citadel Securities saying it's financial repression, what he's doing with the buybacks. High-frequency economics says that he's trying to usurp Fed independence. Is all of that going too far, or is his credibility actually being undermined here?
I mean, all the debt management offices, finance ministries, they are all playing a similar game of trying to work out how the heck they're going to get all this issuance out there, and which parts of the curve are going to absorb it. So we've seen already in the UK, they're really terming in their debt to the lower end of the curve. We've seen that happening in Japan. This is different. I must admit, I feel a little bit more uncomfortable about, rather than reprofiling your issuance, actually buying back in the market, because when the central bank does it, they're anchored by an inflation target for their decisions. We don't know what the anchor is for the Treasury Secretary other than to try and keep interest rates low. So it's certainly not something I would completely ignore. But again, for me, when we're thinking about how do you allocate long-term money and not get caught up in this constant news flow, it's about remaining risk on, but having my assets in place that are going to insure me in case, you know, inflation really takes off. And that's your core infrastructure, transportation assets, your real assets.
OK, and are you positioning for a Fed hike in September? Of course, we're going to hear from Kevin Walsh on Friday at Jackson Hole, and there's another credibility question there.
There is. I mean, I think at the moment, no. Ultimately, the US wage growth data tell me the Fed should not be hiking. It's undoubtable that across the West, headline inflation is elevated, cost pressures are picking up. But whether that becomes a sustained inflation problem depends entirely on the labour market. If workers don't feel good enough about their job security to go in and ask their boss for more pay, that's where inflation stops, because then you have to just cut back on your spending on other things. And the US labour market is just not giving any indication that there's that job security, that workers are going to be asking for more pay. I think what the market wants from Kevin Walsh is just a little bit more clarity about how they see the world. You know, does he agree with that framework that I've just set out of this depends on the labour market and the labour market is too weak? What the market wants to hear is, what is your view of the economy? What matters here? And if he can get that right on Friday, I think that's going to ease a lot of concerns. But I don't think the Fed should be hiking.
Is that too much to ask for, Kevin, really? We just want a bit of clarity. Karen, thank you very much.
Pleasure.
Karen Ward there, EMEA Chief Market Strategist at JPMorgan Asset Management. Well, coming up on the Pulse, having made his first foreign trip to Ukraine as Prime Minister, Andy Burnham is now planning to visit the US next month. We'll discuss his agenda next. This is Bloomberg. UK Prime Minister Andy Burnham says that he and other European leaders plan to travel to the United States next month to lobby President Trump on Ukraine. Burnham's comments came as he visited Kyiv on his first international trip since taking office. Let's bring in Piotr Skolimowski, who leads Bloomberg's coverage for Central and Eastern Europe. Piotr, good to see you. What does Burnham actually want from Washington, and is he likely to get it?
Good morning. So indeed, Andy Burnham yesterday told our reporter, Alex Wickham, in an interview that on the way back from Kiev that he's planning to go to New York next month, when there's a meeting of UN General Assembly, together with other European leaders. He's planning to lobby Donald Trump to send more Patriot missiles to Ukraine. That's an important declaration. Obviously, Ukraine is looking for ahead to winter, and it's really running out of those Patriot missiles that it needs to shoot down Russian missiles. And Patriots are basically the only weapon that's out there that's capable of shooting those ballistic missiles. So Burnham is trying to lead that effort. Obviously, he told in an interview as well that the problem with Patriots is fixable. That it's a big ask from Zelensky. He says he needs 300 of those missiles to survive winter. At this point, it's very difficult to get those weapons for a simple reason. There's a war in Iran, and those stockpiles are running low, not only in the U.S., but also across all the other countries, and that leads to some countries basically hoarding their stockpiles because they're otherwise facing a delay in supplies. So it's a tall order for the Prime Minister. It's going to be his first meeting with Trump. So how it's going to work out, whether he's going to achieve that, that's obviously he set himself up for quite a difficult task. But definitely that's essential for Ukraine to survive, to get those Patriots to the country in time for winter.
Yeah, it's a huge, tall order when it's already a big question about how Trump and Burnham will get on. You talk about weapons, though, and we're also reporting that while Ukraine's defence industry is innovating fast, it's also rapidly running out of workers to keep up. What can Kyiv do about that when, it needs manpower both on the battlefield and in the factories?
Yes, indeed. So obviously the development and how Ukraine has developed its defense tech over the last few years has been one of the big stories of this war. Obviously, it helped Ukraine to sort of offset this imbalance between, the amount of manpower that Russia has in terms of sending people to the front line, and in some cases actually allowed Ukraine to kind of freeze the battlefield on the ground, at least. So what we're seeing right now and what we're reporting this morning is that this defense sector is facing huge problems with manpower. The main, obviously, in terms of employment, this sector has seen incredible growth, over 50% growth in terms of employment over the just last year. And what representatives of the sector are telling us is that, what we're actually seeing is, as one of them described it, internal cannibalism, in the sense that one company is poaching engineers from the other company, offering 3 times the salary and other perks. So the sector is developing very fast, and it's running out of people. Obviously, it's a lot of issues down there. It's a question of skills, which is engineers that they don't have or they have enough. So the companies are dealing with it in different ways. Obviously, one approach is all hands on deck. Basically, it doesn't really matter whether you're HR, whether you're an engineer. If there is a need and there's an order, and they really need a lot of those drones, all people are working, which is obviously not great for the work-life balance for people working for these companies. But they're also trying to ramp up just training. Obviously, it's very difficult. There's huge demand on students, but also the companies themselves are trying to train those people. And I guess the Ukraine companies are also looking for money from foreign partners. That's one way of kind of helping to develop this sector when they team up a little bit more with European, with US partners to continue building this out.
It's really interesting reporting on the economic side of all of this. Piotr, thank you for bringing it to us. That's Bloomberg's Piotr Skolimowski. Well, now let's dive back into the Middle East situation, specifically how the closure of the Strait of Hormuz has exposed the risks of relying on one of the world's most important energy choke points. A special report from Bloomberg Intelligence examines how the world adapted. And we can speak now to Will Hare, senior energy analyst here at Bloomberg Intelligence, who's been behind this report. So, Will, what's the current status of flows through Hormuz, and where does it leave the energy majors? Because it seems like they've been doing pretty well in Q2.
So the Strait of Hormuz is neither fully open nor fully closed. We've had recent reports from U.S. government officials stating that up to 10 million barrels per day was flowing through the strait. We are skeptical of that account. It's not supported by publicly available vessel tracking data. We estimate it's somewhere around 5 million barrels per day. But the key takeaway here is that more oil is flowing through the strait, more than Tehran wants, and it's showing a degree of success that the U.S. Navy, military support, and the convoy escorts that they're completing around the southern Omani corridor is having.
So that's quite encouraging, actually. Are we past peak Hormuz disruption then?
So I would argue that not peak Hormuz disruption, because Tehran has actually recently threatened further attacks on merchant vessels within the strait. But I would say that peak Hormuz dependence, absolutely, we have hit this year as countries, Gulf states, companies are exploring every avenue they have to de-risk, to diversify away from the Hormuz dependence.
So surely that takes away some of Iran's political leverage, geopolitical leverage.
Well, yes. So we argue that they still have leverage over the strait because they do not need a full closure of the strait. They need sufficient threats and of damage, of potential casualties on merchant vessels. However, that leverage is diminishing day after day after day because of the diversification and the strong incentives that these companies and Gulf states have to diversify away from the Strait of Hormuz.
OK, really interesting on how that leverage is changing. Will, thank you very much for bringing us the report. Senior energy analyst at Bloomberg Intelligence, and that report, Peak Hormuz, available on the terminal for subscribers now. Well, coming up, billionaire investor Stanley Druckenmiller says the US Treasury Secretary's bond buying plan is a mistake. We'll discuss next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Lizzie Burden in London, and these are your top stories. Risking a collision with China, Treasury Secretary Scott Bessent threatens to unleash an economic D-Day against Iran and its trading partners. Tentative optimism. Nasdaq futures extend gains with easing pressure on tech stocks ahead of key earnings this week, including AI bellwether Nvidia. Plus, could an extra 40,000 jobs be on the line? Unions fear cuts at Volkswagen could balloon to 140,000 jobs as the CEO prepares to address the company later today. Well, billionaire investor Stanley Druckenmiller has suggested that his former pupil, US Treasury Secretary Scott Bessent, is making a mistake by wading into the bond market to push down yields. Druckenmiller argues that policymakers should let the bond market do its job. Joining us now is Maria Demertzis, Economic Policy Professor at the European University Institute, and we can get the European perspective on all of this now. So, Maria, thank you so much for joining us. In your eyes, is Bessent losing credibility? And what signal does what he's doing with the bond market send to European policymakers?
Well, I mean, any finance minister or treasury minister has the right to come into the markets and buy back bonds. So the question is this an effective way of affecting the price yields? And how does this interfere with the central bank intentions? I mean, we're expecting the Fed to increase rates at some point. I mean, this is what markets are expecting. So the idea that the Treasury, the finance minister, is intervening somehow contradicts the ability of the central bank to achieve its objectives. So that already creates some confusion into the economy in terms of where we're going with yields in the future. And that is why we've seen some reactions coming to this. Now, when it comes to Europe, I don't think that interferes much with the ability of policymakers in Europe to make their own decisions, be them finance ministers or indeed the European Central Bank, the ECB. However, I will say that to the extent that the interference by the Fed to affect bond yields in the U.S. Reflects some concern about the viability of the U.S. Debt, that's not good news for the European economy or indeed the world economy. U.S. assets, and treasuries in particular, are the asset of last resort. They are the safe asset. And to the extent that there is some worries about the viability of the safe asset, then the whole world needs to watch very carefully, because it will affect the European economy and it will affect the world economy. It's so systemic to the holdings of insurers, of pension funds, of banks, that, it is really worrying to see something happening to U.S. yields.
Well, yeah, Karen Ward was on the show earlier, and she was making the point not just that, Treasury markets affect all bond markets, but also that everyone's got their fiscal woes at the moment. So lest we forget the fiscal woes here in Europe, Maria, what can be done on the continent for Europe to grow its way out of debt?
Yeah, indeed. Europe has always had, certainly in the past 10 years, has always had worries about the sustainability of its own debts as well, particularly for big countries. When big countries have fiscal debts and deficits that are high and increasing, then, of course, that is a sign of concern. Markets don't seem to worry about the sustainability of European debts, but they remain high. And it is important that the productivity agenda, let me call it the Draghi agenda, really advances, because that is the only way to grow out of high debts, and that is absolutely crucial. And I hope that we continue to make the right investments, productivity investments, reforms that are going to remove some of the idiosyncrasies and the problems of the European economy. So the Draghi agenda, in my view, remains priority number one. But of course, we have the issue of economic security as well in Europe. Crucial that we advance with economic security, because otherwise we remain vulnerable to coercion from players outside our borders.
But is Europe meaningfully implementing the Draghi agenda, or is it just talking about it?
Well, no, I think that we are meaningfully advancing with it. From the simplification agenda all the way to energy union, there are steps that the European Union is taking to advance with that. But Europe is slow. It's not just one country that is taking decisions. It is 27 different countries and, of course, coordinated action at the European level. So that, of course, delays progress. And that has always been the problem of the European Union. It is true that we are not advancing at the speed that we ought to be advancing, but there you are.
Well, yeah, when it comes to common European debt, without the political will there to make that case, is it going to take an existential crisis to get it over the line?
It usually does take existential crisis to make advancements in Europe, and that is very unfortunate. But we have done it when we had to. The issue of debt, the case for a common European debt, has never been stronger, given the urgency of implementing investments on European public goods. However, again, we are very slow to advance in this regard. I would be watching the discussions on the next European budget, the multi-annual financing framework, the MFF. President Costa is visiting European countries to try and push over the line to agree on a rather ambitious new budget. That is not common debt, but it is in the right direction in terms of financing European public goods, and hopefully the first step to greater spending at the European level when it comes to the urgent problems.
I wonder if you've seen the IFO numbers this morning. Germany's business outlook actually improving for a fourth month. You've got a boost from public spending. What's your read on the general health of Europe's economy at the moment, given all of the heat waves, the Freudian slip there, the tailwinds that the headwinds that we're seeing at the moment, the heat waves, the wars, tariffs as well?
Well, I mean, despite all this, as you say, huge shocks from climate all the way down to wars, the European economy remains actually resilient. We've seen it also on the inflation side, but also on the growth side. Admittedly, growth in Europe is rather weak, but we have seen that the European economy has managed to deal with the volatility of it all, which means that we are doing the right things to try and preserve some stability in our economies, which is good. It's great to see the German economy that actually suffers to do well for a number of months now, which means that the implementation of investments and the huge commitment to investment is beginning to show some positive news. So I think I will be watching to see whether this is sustained. And if the German economy is moving, that, of course, takes the European economy with it. So on the whole, I think stability is good news. And let's see the fruits of some of the investments that we've already committed to.
But how worried are you about European gas prices heading into the winter? Because we were talking about the geopolitics in the Middle East earlier, and it seems the situation's only going backwards.
Well, that is indeed a vulnerability problem. We have seen also that the storages of energy are actually a little bit lower this year than they were last year, which means that our buffers are smaller to begin with. If the winter is cold, that will be a problem. However, you know, that is a problem that the European Union has had for the past 4 years since the beginning of the war in Ukraine, and it remains a vulnerability point. But we are advancing with the energy union, we're advancing with the green transition, again at the speed that Europe usually advances. But we are moving in the right direction. We are hoping for a little bit of luck this winter, so that we can deal with the volatility of prices that is coming through energy. But there you go. We have had this problem before. We dealt with it. I hope we can sustain it this winter as well.
Just finally, we were also talking about how the US is set to reimpose tariffs on Chinese goods ahead of the Trump-Xi summit. To what extent is Europe exposed to that crossfire?
Well, it is exposed, but quite frankly, I don't think that is the biggest problems we have today. We have our own issues with China and how to deal with them. I think that's much more important for the European Union. We will continue to see tariffs coming from the US, and not only tariffs, but also the unpredictability of tariffs. This economically is not a big issue, but politically it is. We have seen it now for 2 years, and I think the European Union is able to deal with this. The response to US tariffs has been, in my view, correct. We should not escalate when we don't have to, but we have to deal with underlying problems, and that is primarily China and how to deal with unfair competition that is coming in that direction.
And do you think that where you've got Canada standing up to the US and China as well, perhaps that would encourage Europe to do the same?
Look, the European Union is exposed to the US primarily when it comes to the war. We need the US to help us support the war and to help us end the war. So I think the exposures that the European Union unfortunately faces, and that's why I raised the issue of economic security, we need to do something about that. They are not the same as other countries. And I think this is an escalation game, and we should not fall into the escalation trap. Up till now, I think the European Union had the right position when it comes to this trap of tariffs. Let's hope that we continue to cooperate with the US for the sake of ending the war as quickly as possible, and also for the sake of economic outcomes. Even if we impose tariffs, counter tariffs to the US, this will not benefit the European economy. They don't call it a trap for anything, and we should not escalate.
OK, cooperation, not escalation. Clear message from you there, Maria.
Indeed.
That's Maria Demertzis, Economic Policy Professor at the European University Institute. Thank you very much, as always, for joining us. Well, the Volkswagen CEO, Oliver Blume, will be presenting his restructuring plan to workers at the company's giant Wolfsburg factory later on today. The proposals could wipe out as many as 100,000 jobs. Joining us now for more is Will Wilkes, our automotives reporter out of Frankfurt. So, Will, what exactly is the CEO trying to achieve with this restructuring then? And why is the pressure on Volkswagen just so intense right now? Remind us.
Good morning, Lizzie. So what he's trying to achieve with this restructuring plan is to get Volkswagen's operating margin from just below 4%, where it is now, to kind of between 8 to 10%. And that's, he thinks, is necessary to make it still an investable company while it's tackling the shift to electrification and the shift to cars as kind of rolling computers, both of which technology shifts require huge investment. And the reason it's becoming more urgent is because Volkswagen's being hit left, right and centre by different problems that are also hitting other automakers, like the decline in the China market, fierce competition from Chinese manufacturers in Europe, as well as the lingering impact of US tariffs. So Blume is trying to push ahead with this restructuring package, which the unions say is not necessary. And they say the geopolitical environment makes his targets. The head of the IG Metall Metal Workers Union last week said those were cloud cuckoo land assumptions that Volkswagen can get to margins between 8 to 10%.
Well, how much power actually does the Labour side of the argument have to block his plans?
Actually, different to lots of companies, even in Germany, the Labour side is able to effectively block the plans. Under German corporate law, supervisory boards need to sign off on major strategic decisions like a package like this. Also, by German corporate law, supervisory boards are made up of 50% seats to Labour. In Volkswagen's special case, the German state of Lower Saxony, where several major Volkswagen plants are located, also has a vote. So if Lower Saxony groups together with the unions, they're able to block job losses and plant closures. And I met with the minister president of Lower Saxony last night in Hanover, and he was saying we can't accept work closures without any future plans for them, and we can't accept compulsory job losses. So it's stuck, and Blume needs to try and get these two factions to back his plan. And from the way things look with the meeting next week, that looks very difficult indeed.
OK, well, we'll keep an eye on the VW shares throughout the day then. Will, thank you for the update. That's Bloomberg's Will Wilkes. Now, let's come to the UK, because a property company owned by Britain's richest aristocrats warning that rising temperatures and planning regulations are threatening the appeal of its properties in London's Mayfair and Belgravia. The Grosvenor Group wants the government to relax planning requirements to allow for basic cooling features. We all like some of those. Joining us now for more is Olivia Rudgard, our climate reporter. So, Olivia, this is a sore spot for many of us living in beautiful listed properties with no aircon. What's stopping older properties getting these features that do something good, keep residents cool?
Yeah, so especially if you live in a listed building, there are some pretty strict restrictions on what you can do to anything that affects that building, actually inside and out, but especially on the outside. So things like air conditioning are really difficult. What Grosvenor actually wants to allow or encourage is more like passive features, so things like shutters and shading. And those also, you might think they'd be easier to get, but they also require permission if you have a listed building. And actually, even if you don't, you may well need to apply for planning permission from the local council if you live in a much more ordinary building. So there are these layers of bureaucracy that you sort of have to get through, and it can cost several £100s and take quite a few weeks to obtain. OK, so it's not just that we're used to cooler climes, it's also that we're trying to protect the integrity of these buildings. So how might this affect property values in London? Let's say that this is the new normal, that summers just get hotter and hotter and hotter. If we can't have aircon, what does it do to prices? Yeah, so I think what Grosvenor is really saying is that these buildings, they'll be maintained and looked after if they're lived in, if they're up to date, if they're something that's practical and actually being used. And buildings fall into disrepair when they are being neglected because they're just not up to date. And so what they want to be able to do, both in terms of keeping them warm in the winter, so adding insulation, double glazing, things like that, and then also being able to keep them cool in the summer, is keep those buildings in use. And then the idea is that that stops them from falling into disrepair, and then that could affect their values as well.
OK. I, for one, think it's all a ploy to get us to the office for longer hours to make the use of the aircon. Olivia, thank you very much. That's Olivia Rudgard, our climate reporter. Well, coming up on The Pulse, we'll be looking ahead to NVIDIA's earnings with Adrian Cox of Deutsche Bank Research. That conversation next. This is Bloomberg.
This week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
This is The Pulse. I'm Lizzie Burden in London. Now, NVIDIA shares have posted their longest losing streak since 2022 amid a global sell-off in chip stocks. The chip giant's earnings tomorrow will be a key test of confidence in the AI trade. And joining us now to discuss the wider tech sector is Adrian Cox, Thematic Strategist at Deutsche Bank Research. Adrian, great to have you around the desk this morning. So we're reporting that NVIDIA's earnings will be showing likely a doubling in data center revenue from a year ago. Just generally, when it comes to the tech space, expectations are so high right now. Is there anything that the likes of NVIDIA can report that could impress a market like this?
It's very difficult at the moment to impress anyone.
Yeah.
And we've obviously seen this in the last few days with NVIDIA falling by, about 7.5% in the last 7 trading days. So evidently, the market is looking at these infrastructure stocks, the picks and shovels, which have really outperformed everyone else over the time since ChatGPT was launched, and trying to find where the edge is. And it's not clear whether they can still maintain that. Obviously, what is going to be key for NVIDIA and other stocks is going to be, number one, the guidance. Number two, is there going to be evidence of a kind of swapping from one supplier to another? So instead of NVIDIA, it might be some of the other chip producers making ASICs, for example, their own sort of custom chips. And also the implications of things like export controls and whether that's going to perhaps damp the sales going forward. OK, but we report that some of NVIDIA's biggest customers have been told the prices of its AI servers are going up more than 15%. Now, in your notes, you've written that cheaper AI will likely boost spending. So this is the opposite. Is that sort of tactic by the likes of NVIDIA actually not very wise right now? Well, really, I think what's going on, if you just take a step back, is this distinction that's going on in the sort of format wars between the open source models on the one hand and the proprietary models on the other. And what the open source models have shown over the course of the summer is that you can really perform most of what you need to perform at a very much cheaper rate than is being performed by the proprietary models. So if you have the biggest proprietary model at the moment, then it's going to cost you or sort of the open source kind of equivalent for something which is more or less the same is going to be about a quarter of the price if you're using a Chinese open source model. If you want to use something where you can just take a little step down in quality, you can get something for maybe a tenth of the price. And so I think the bigger picture that we're seeing is this kind of shift where there are more models out there available, and therefore it gives the chance for producers like NVIDIA to sell more AI, even if that is to the disadvantage of one or two of the proprietary model makers.
Yeah, because you've got OpenAI building its own chip, Anthropic building its own chip, Meta signing deals with seemingly everyone, Amazon saying that its in-house chip business would generate $25 billion in revenue as a standalone. When you've got the hyperscaler chip arms race going on like that, how does it hurt the likes of NVIDIA?
Obviously, every new competitor is going to be good for the market, I guess, because that means that consumers have choice of who they can refer to. One of the most important things really about open source actually is that it's not just a cost play and a sort of an opportunity for consumers, enterprises to choose which model they want to use. But it also means that there's more competition out there, which means that there's competition not just for the models, which are the kind of commodity side of things, but also actually more up and down the stack, because there's less kind of lock-in for a specific chip.
OK. And then also, if we talk about CapEx, you've got NVIDIA becoming the bank of last resort, effectively, for the AI trade overall. Do you look at that web of CapEx, and Bloomberg's got some fantastic maps of this on the terminal. Do you look at it and think it's just trying to do too much, it's all too dangerous?
Well, I think at the moment we're still really looking at very, very strong demand. So by some forecasts, there's at least another 4 or 5 years before current demand will actually be matched by supply. So even though obviously there is going to be quite legitimate examination of the kind of funding structures that all of the different hyperscalers and the model providers and everyone else are engaging in, and questions about the opacity of that, the bigger issue is the fact that really there's just no stopping this demand. And until demand begins to dry up, then all the questions about, you know, the sort of the short to medium term sustainability of the financing are somewhat moot.
So these levels of investment continue for 4 or 5 years?
It looks like it, yeah. Okay. I mean, if you imagine that maybe only 20-30% of companies are really using AI, and very often those are mainly just kind of pilots at the moment, just imagine all of those companies using AI more extensively and more companies overall using AI extensively. That gives you an enormous runway for greater demand to grow.
And how do you think about the threat from Chinese AI?
Well, China's been playing a really interesting role in all of this, and I think obviously we had the DeepSeek moment at the beginning of last year. If you look at what's happening in EVs, actually, it's quite an interesting analogy. So EVs now, about 75% of global production is Chinese and about 5% is American. So the Chinese overtook the US in about 2015 and have been growing very fast ever since. And in a way, this should be a wake-up call for the US that shows that just because you have the kind of the start of the technology doesn't mean that you can necessarily expect to continue that. And in the case of the Chinese, they took a disadvantage, which was not really being able to compete on the internal combustion engine, but having very strong capabilities around batteries, and then turning that into a successful model around cars. And I think we're potentially seeing the same limitations being the mother of invention on open source models too.
Just because you're the first doesn't mean you'll always be the best.
Absolutely not. And you really see this actually in the history of AI, where one not only model but also kind of model has just overtaken another over the last few years.
It's a really interesting comparison. Adrian, thank you for joining us this morning. That's Adrian Cox, Thematic Strategist at Deutsche Bank Research. Well, before we wrap up the hour, let's just check back in on these markets. And we are looking at Nasdaq futures up now 0.6%. They've got the wind in their sails this morning. The dollar is steady against its major peers. Brent is now weaker by 2% at $90 a barrel, and Bitcoin shy of the 80k level it had surpassed earlier. But coming up this evening, we'll be hearing from the Premier of Canada's Ontario province, Doug Ford. We talked about him earlier. He's found himself at the centre of a war of words with President Trump. So that coming up on Balance of Power at 10 p.m. London time. We'll pass you to the brief now. This is Bloomberg.